In this segment of Mad Money, Jim Cramer discusses the economic weakness and the fear in the markets as indicated by the significant decline this past week. He criticizes the Federal Reserve for not cutting interest rates sooner. Cramer also mentions various signs of economic weakness, such as Intel's poorly missed quarter, widespread pain in the retail sector, and weakness in the Chinese market. He notes that certain stocks like Procter & Gamble and Kimberly-Clark have seen significant increases despite reporting bad quarters, indicating fear in the market.
The stock market at pivotal times. Today was one of those pivotal times because the 10-year Treasury is a very visible piece of paper to a lot of the big investors in the world, and it plummeted in yield, crashing through the 4% level to 3.98%. That's the lowest it's been since February. I know it doesn't sound like much, but it triggers a lot of other things. Why does it matter? Because the 10-year is the sum of all of our fears about the economy. When the economy is too hot, when inflation's roaring, the 10-year tells the tale and plummets in price, sending yields soaring. That's usually a sign the Federal Reserve needs to rein in inflation by raising interest rates. But you know what? It can be bad, too, when rates fall. When the 10-year yield crumbles, when it goes down very hard, very fast, that tells us the Fed better get started cutting the darn rates. In fact, it makes them look ill-advised for not cutting at yesterday's meeting. And that's what caused this decline. To me, today's terrible action stocks was a function of the Fed not cutting rates yesterday at that Federal Market Committee meeting. The slowdown in the economy, the brown shoots, as I call them, has gotten much more palpable. They've turned into brown fields, with whole sectors starting to lie fallow. Yes, both the 10-year Treasury and the echoing stock market are saying the same thing. Jay Powell, you got this one wrong. You should have moved yesterday. September's too late. The evidence is too stark. How did you miss it? What were you listening to? Didn't they see the 10-year Treasury signaling economic danger? All right. Take a step back. The Fed's always fair game for criticism. But I feel they never get enough credit for doing anything right. I mean, the second guessers will be shamed if we get a strong employment number tomorrow morning. Wasn't enough that Jay Powell said, look, they'll cut rates in September if the economy weakens? Chiding this Fed feels like a mistake. Inflation seems so intractable for so long, and now they've got it on the ropes. Plus, the soft economy is brand new, for heaven's sake. Last year at this time, there was almost universal criticism that the Fed was powerless to tame inflation, was too embedded. So I have better things to do with my time than lambaste the Fed chief for conceivably letting the economy wither for 7 more weeks. Of course, Powell wants to give it more time. He lived through the 70s, so did I, when the Fed would cut rates every time the economy started slowing, and then inflation would roar back again. He's a thoughtful, considered man in a world of thoughtless traders who do not get the consequences of moving too fast to bring rates down while inflation's still kind of hanging around. Plus, it's more than a little foggy out there. The slowdown isn't all that visible. Hey, last night, Meta Platforms reported an extraordinary quarter, in large part because it's been able to make its targeted advertising more efficient than ever. Advertising aimed at 3.27 billion daily average users. Holy cow, active users, I should say, which is up an astounding 7% year over year. Meta's spending a huge amount to have enough computing power, and CEO Mark Zuckerberg says he'll shell out maybe 10 times that for the next generation of its large language model infrastructure because the opportunity is so enormous. More on that later. After the close today, though, we got the other side. 2 other Mag 7 players that didn't deliver. Amazon, well, let's say the results were imperfect. Sales came in light despite real strength at Amazon Web Services. Earnings were better than expected, so the revenue guidance was weak, although they tend to always do the guiding very conservatively. Amazon's got to keep spending on compute, if only to keep up with Alphabet and, more important, Meta and Microsoft. Apple, though, put a clean top and bottom line beat despite severe weakness in China. Market's so negative on tech, they're not going to give Apple the benefit of the doubt. They never do. Of course, we got another story from other tech companies. I interviewed Rene Haas, CEO of ARM Holdings, the gigantic semiconductor design company. I did it this morning, and he talked about there was weakness in the Internet of Things. Huh? That's industrial tech. News reverberated throughout lots of tech, including Micron down 7.5%. Texas Instruments down 5%. Semiconductor capital equipment giant Lam, it reported a good quarter. It left people feeling a little bit queasy, though. And you know what? After an historic run from 574 last October to 1,133 weeks ago, well, that's how you get a 10% haircut. Then after the close, Intel, a company I've warned you again and again and again about, including yesterday, well, they missed their quarter on all fronts, and they suspended their dividend. It is not safe. Tech's been a bastion of strength for so long, but now that bastion seems to be on the ropes, too. Last night, I talked about how there's been a downturn in discretionary spending. This morning, Wayfair Furniture reported a weaker than expected quarter. And more important, they said that this environment is like the Great Recession. We've heard from that refrain from RH's Gary Friedman. His stuff's pretty expensive. I mean, Wayfair's every man. Jay Powell doesn't care if RH hurts customers. You can't afford it. You can't afford the customers. But Wayfair is much more bargain-oriented. That means widespread pain.
The House of Pain.
Travel's been one of the true bright spots in the economy, but yesterday Marriott says it's seeing weakness in America. I wouldn't normally worry, but today MGM Resorts said it was concerned about flagging advanced sales for its Formula One race. Remember that? That was such a huge hit. The rooms went to absurd levels. And maybe that's what's happened. That's why the stock's down 13% today. You have to wonder if it's a big deal. I don't know. I call it disconcerting. Of course, there are other signs of weakness that are obvious. China. I mean, one more horrendous day for anybody connected with China. I measure the health of the Chinese economy by looking at the Baltic Freight Index, which gives you shipping rates, and they've now been down for 10 straight days. You'd think China couldn't possibly be still so important. It's important for Apple, though, and the Chinese economy, let's say, I don't know how it can get back on track. I don't see it. I'm sick and tired of hearing that it might be stimulus. I've given up on that, in large part because the Chinese Communist Party doesn't seem to believe in the stimulus either. Sometimes I don't want to overthink this. You can tell how much fear there is by looking at what's going higher. Both Procter & Gamble and Kimberly-Clark reported really bad quarters, and their stocks were acting as if both reported blowouts. Abbott Labs lost a court suit last Friday where a jury awarded the plaintiff $495 million as recompense for what the plaintiff claimed was defective baby formula that caused a terrible infant illness. That stock's up huge since then, including about a 4% increase today. You don't get that kind of action when the economy's humming. These are all classic slowdown stocks. Bottom line here, this is suddenly a market that's given to violent extremes. It keeps turning on different segments with a vengeance while rewarding just a handful of others. Today was tech's turn to get mauled by the bears. And with Amazon's revenue miss after the close, the beatdown could continue tomorrow. Although, once again, I think it's selling Apple down huge like it is tonight would be suboptimal decision-making. I need to go to Troy in Florida. Troy.
Hey, Jim, Cramer, big fan. I don't always agree with you, but big fan. I wanted to see.
I'm glad you're a fan of the show. Well, how can I help?
I wanted to see, what are your thoughts for the next 12 months for Ford Motor Company?
Well, I've got my own reservations about Ford. I've decided to sell it for my charitable trust. They have failed to deliver what I expected them to do. Let's go to Abraham in Georgia. Abraham.
Hey, Jim, how are you?
Oh, good. Sorry if I mispronounced your name. That's my bad. But how can I help?
You said it right. It's okay.
Thank you.
I've been getting information from your show, and it's very helpful. I'm really appreciate it. I just need to know about this CRM.
Sure, and I really appreciate those words. Today's a hard day because both Apple and Amazon report. I really want to try to do a good job for you and all our viewers. It's just very, very difficult. I would say that Salesforce, we trimmed back a little bit because I don't like enterprise. That's enterprise software. But you know what? At 240 is where I would probably say it's okay again to buy. Can I go to Marcus in Oregon, please? Marcus.
Hey, Jim. Thanks so much. Love you on Squawk in the Morning.
Thank you very much.
I'm looking for a shopping list. The week after next is Car Week in Monterey, which is like the biggest, most expensive car show in the world.
Okay.
Thinking about cars. God, I'd love to buy Ford because it looks pretty cheap, but my favorites are still Ferrari and Tesla. What do you think?
Okay, I like Ferrari very much. I think Tesla's much more now. He's trying to feature, Elon Musk is trying to portray it, frankly, as a tech company. If it's a tech company, then I think you can buy it right here and not worry about Monterey. But I thank you for that information. I didn't even know that myself. Let's go to Adam in Georgia, please. Adam.
Mr. Jim, what's going on, dude?
I don't know. Tough night. You know, trying to understand Apple, trying to understand Amazon, trying to do a good job for you. Sometimes I don't feel I deliver, and I apologize, but I'm doing my best.
Gee,
What's going on?
Man.
No, I'm
dude.
not the man today. I'm not the man.
Oh.
This is 4 times a year we have this one day, and I cannot deliver what I'd like to do. I cannot deliver the quality product I like to. I'm sure I try. I always try, but it's very tough. How can I help?
Well, we appreciate it. All right, check it out.
Thank you.
I held Home Depot for 20 years, rolling over my dividends the whole time. And I was wondering, is there anything I can do with that?
I think you just keep doing it. Look, it's got a 2.5% yield. It's got a great balance sheet. When the Fed starts cutting rates, people will start doing more transactions with homes. This stock trades on transactions of homes. When rates go lower, you get more transactions, and that's why it's a good stock to hold. And below 350, I would buy the stock. Look, this market has all of a sudden given us violent extremes. Today's tech turned to feel the pain. And given Amazon's revenue miss after the bell and how no one really is going to care about whether Apple says things are fine, could have some more pain tomorrow.